So I've been doing this podcast for just over 3 years and I really want to bring it live for you all. So I'm going to need a favor from you. If you're interested in seeing the Savvy Wallet podcast live, please register your interest by signing up to my mailing list with the link in the description of this episode. Thank you so much for your support so far.
99% of people, regardless of bad credit, can access some form of mortgage.
Okay.
It's more of a case of you may have to pay a larger deposit, you may have to pay higher interest rates. If you do have an event of you have missed a payment here and there, that doesn't mean that you can't access the best deals either. It's all about preparation. The earlier you prepare, the more chance you're going to have of success. And social media may have you believe that we all need a master plan with our credit score in order to buy a home. In my opinion, that's not the case. So most mortgage lenders on the market will borrow up to around about 4.5 times the income on the application. It will come down on that with debts, children, adverse credit history. There are lenders at the moment who will go up until 6 times your income. There's a little bit of a myth that there are self-employed mortgage products. There aren't. Self-employed applicants have access to the same mortgage products as employed applicants. It's just that the evidence that they need to provide is a little bit different.
One of the big changes that's happening this year is stamp duty changes, right? Coming into effect in April 2025. What are these stamp duty changes and how do they impact first-time buyers and existing homeowners?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people.
Like you have to be able to be uncomfortable.
Yeah.
Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building, a repeat guest actually. We had a really good conversation last time out. So if you haven't tuned into that episode, make sure to go and tune into that one. So we have Dan, who is a mortgage advisor who has helped several, or should I say, who has helped hundreds of first-time buyers secure their first mortgages. Dan, how are you doing today?
Very well. Thank you very much for having me back.
Yeah, it's good, man. I mean, the last episode did very well. And, a lot of people were saying how they appreciated that conversation, and a lot has happened, of course, in a year in terms of like, you know, on the property front and mortgages front. But one thing that doesn't change is that people always want to buy a house, right? And we're going to get a lot of people, you know, whether it's first time buyers or even people remortgaging. You know, for me, my remortgaging is coming, so I think this is going to be very interesting for me. So I described you a little bit. Who would you say Dan is?
Yeah, so professionally, I am a mortgage advisor who does sort of niche and work primarily in the first-time buyer market. As you've said, I've helped hundreds of first-time buyers to buy the first home. The aim always being to make mortgage advice accessible, digestible, enjoyable for the masses, if possible.
Yeah. Amazing. And this is, I think this is going to be interesting. We got lots of interesting questions and, you know, areas that we want to definitely talk about. You know, so you say that you help people as a mortgage advisor. Can you talk about what that help actually looks like?
Absolutely. So it's essentially my job to, let's say I'm working with a first-time buyer. It's my job to hold that first-time buyer's hand from that initial mortgage appointment all the way until they get the keys for their first home. That could take 6 months, it could take 6 years, but to help them navigate that, make sure they achieve the goal on time, first time, with minimal stress. And yeah, a mortgage advisor or myself would be in their corner on their team through that journey. Yeah.
Hopefully, you know, it doesn't take 6 years. I mean, if they're saying for deposit, I get it, right? But, you know, hopefully the process that take that long. That's crazy. So when we spoke last time, or I can't remember if we spoke on the podcast or offline, right? You were in the process of buying a property. How did that kind of go?
Yes. So in April of 2024, I officially completed the purchase of our second home. So I actually bought what was my gran and granddad's house. So I grew up sort of with one set of grandparents around the corner from my gran and granddad. Always said I was going to buy that house. I always intended to. Reality is when you become an adult, a lot of things need to align. But yeah, when we lost my gran, we also found out we were pregnant with our second child the same week. And it was a case of, right, let's buy the house. And yeah, in April of this year, that completed. So we're all settled in now.
Congratulations. That's a big, that's a big deal. Like being able to, get your like move property and get a property, and condolences obviously for, you know, loss of your grandma as well. Wow, that's so interesting, the fact that you were able to like move on. And I'm sure for you as well, you had two big things happen, right? Like, you know, new baby and you know, getting a property. But how do you deal with all of that?
Yeah, so we completed the purchase in April, and my partner gave birth to our baby in May. So it was quite a close call. There was a little bit of stress at the end of the purchase, as we knew the baby was coming soon. But yeah, we managed to get the purchase done in April and then move house in May. So busy year, but a good year.
Yeah, gosh. Okay, so let's get into this, right? So let's talk a bit about, like, you know, first time buyers and what the market was like in 2024, so people can have a bit of a better understanding of it. So, you know, in general, how many first time buyers were there in 2024? And was this more or less than, you know, in 2023?
Okay, so in 2023, the amount of first time buyers was the lowest that it had been in the 10 years previous. In 2024, some banks and some lenders were reporting an increase in first-time buyer purchases of around about 13 to 14%. So, yeah, we're definitely built on the year before, and it's a positive sign.
And was there any like main reasons why, I guess, there was an increase in 2024 as opposed to 2023?
So the economy in maybe 2022, 2023 was quite hectic. There was a lot going on, a lot of bad news on the news. 2024, in some ways, was maybe a little bit more stable. Whether or not you could describe it as stable, we could argue that, but more stable in 2024. That then allowed people to make that decision, right, maybe I'm not hearing all the bad news on the news every day now, so let's have a chat and see what's possible. And I think in the UK, culturally, people want to buy homes, so there's only so long people are prepared to wait. A lot of people are going to make that purchase at some point anyway.
Yeah. Okay. Love that. Very, very interesting, because I think that the fact that you said that people are responding to the news, which is, I think that's true. That is true. People will respond to it, whether it's interest rates, whether it's inflation, you know, or whether we think that a recession is going to happen. People are going to be like, well, actually, you know what? I don't want to buy a house, and then maybe buy a house, move out or whatever, and then I lose a job, right? So there's a bit of a safety element, I think, sometimes in that. What's like the trend looking like for 2025, I guess? Yeah,
so I'm hopeful that it's going to be another busy year. I would expect it to maybe slightly to be busier than 2024 again, hopefully this year. You know, there's a lot of figures, and the market isn't in an ideal place. Maybe it never will be. You know, still, the average in the country is that property prices are 9 times the average salary. In London, that can be 14 times. I actually seen quite a horrific statistic the other day, which was in 1997, average house prices were less than 5 times the average income in 88% of the country. That's now down to around about 7%, which suggests that, you know, for a sole applicant, properties in the majority of the country are unaffordable. So it is still a difficult time. Interest rates have been quite stable for around about the last 12 months in terms of your fixed interest rates. But can it be done? Absolutely. You know, we do it every day.
Yeah. That is shocking, though. That is really shocking. The fact that, you know, you're saying that like for the average property price was 5 times people's salary in 88% of the UK. That's wow. And it's dropped down to 7. That is crazy. And this is the thing, right? When we have these kind of conversations and where we kind of want to guide people, although it's more difficult, it doesn't mean it's impossible, because there's ways around it. And we're going to talk a bit more about, like, you know, what people can kind of do and, you know, how they can kind of prepare for that. I think it would be really good if you could share some tips on, you know, how people kind of maneuver that, because it's quite challenging, right? To get your first property if in that case, right?
Absolutely. In terms, well, the key word is preparation. It's all about preparation. The earlier you prepare, the more chance you're going to have of success. What does preparation look like? That is speaking to a mortgage advisor as soon as possible. It's never too early to speak to an advisor. Just get an understanding of what your income looks like in terms of buying the sort of home you want to buy. How does your debt look? Do you have too much debt? Is it okay? Credit reports. Most people have never looked at a credit report. Have that early conversation with a mortgage advisor, and that will stand you in good stead. As well as that, start saving a deposit. early. You know, if you save a lot of money for a deposit, that doesn't mean that you're going to need to use every penny for that house deposit. But having that money available to use will give you the flexibility when it comes.
Yeah, it's very, very important. Coming into 2025, I was reflecting on one of the best decisions I made for my business in 2024, which was setting aside just a few minutes to open a business savings account, which would get my money working for me. Personally, I had business funds sitting idly in a current business account, earning no interest at all. So when I found Ties Instant Savings Account offering 4.07% AER Variable paid monthly, I knew I had to act fast and open an account. Now I'm eagerly looking forward to seeing how much passive income I'll earn on my business funds when the interest rolls in at the end of each month, all without lifting a finger. Tide, who is kindly sponsoring this episode, is giving any new members who sign up and use my code SAVVYWALLET £100 when you fund a Tide Instant Savings account with £5,000 within the first 30 days. So you get £300 plus a 4.07% AER variable on your business savings. You could potentially be earning hundreds of pounds a month. I also know that peace of mind as a business owner is essential, and with Tide's Instant Savings account, I feel reassured in the fact that I can withdraw business funds instantly through the Tide app. I get FSCS protection on up to £85,000. It has unlimited deposits, no withdrawal fees, and a current account isn't required to open it. Opening a Tide Instant Savings account is easy and only takes 4 steps to set up the account. If you're interested in this special offer, tap the link in the description of this episode and make sure to use my code SAVVYWALLET to get the £100 bonus. 2025 is the year for putting your money to work. Terms and conditions apply. For full details, please visit tide.co/terms/SAVVYWALLET You'll find a link in the description box below and displayed on the screen. Rates are correct as of 17th of December 2024. And, you know, talking about importance, Labour, right? They pledged to build 1.5 million homes, right?
Mm-hmm.
Whether or not it's realistic, you know, that's a different question. But let's assume that they do manage to achieve this, right? How would that impact, you know, first-time buyers and actually even existing homeowners as well?
Okay, so whether or not they will do it, who knows? You know, I would never base your home buying plans on pledges such as that, because one, will it happen? Two, there's so many moving parts anyway, so many different moving parts. It's really complex. But yeah, if there was a significant increase in supply, that would help. Simply, it would sort of help to control house prices going up because there's more homes available for the buyers. But yeah, that is sort of one small part of it.
Okay. Cool. Well, I really appreciate that. And I understand, because it's like the thing about more homes or having more homes, right? Like you say, is that definitely is going to be a supply. So potentially the prices could be, you know, more or less lower. Talking about mortgages, right? If we think about mortgages, right, and people preparing for mortgages, this is a wide question, but, you know, I'll let you answer it. What do people need to think about and ensure that they have in place, you know, in terms of getting that preparation ready for mortgage?
Yeah, so you will need a deposit. So if you are, let's say you're a first-time buyer, the Lifetime ISA is a fantastic tool. If you are looking to buy your first home, you know, Lifetime ISA is suitable if you're buying a property for up to £450,000, or if you're not looking to buy in the next 12 months. You can only benefit from a Lifetime ISA if you're buying 12 months after your first payment into the Lifetime ISA, or for a property up to £450,000. So yeah, start saving that deposit early. Sorry, what was the rounded question? It was
so what do people need to think about and then have ensure? What do people need to think about and ensure that they have in place to like start preparing for like a mortgage?
Perfect. Okay, so documentation with your mortgage advisor. If you are looking to make a purchase in the near future, start thinking about, are you receiving payslips? Do your payslips match what's going into your bank? They should do, but you may be surprised that it isn't always the case.
Yeah.
Have a chat with that mortgage advisor. And a big one is credit scoring. As mentioned, most people don't look at credit reports. One of the biggest credit score tips that I have is always not to make a mess of it in the first place. If everybody from the age of 18 just had an awareness of how important your credit report is, making your repayments on time, a lot less people will find themselves in sort of difficulties when it comes to the mid-20s or 30s.
Yeah.
You know, some people may have bad credit due to things such as abusive relationships or a bad breakup or things like a job loss, for example. But in my experience, and I do look at a lot of credit reports, a lot of the time it's just bad habits and a lack of care, typically when young.
Yeah. And, let's stay on that topic of credit, right? How does your credit score in your report, how does that impact your ability to get a mortgage offer, and I guess how good that offer is?
Absolutely. So when applying for a mortgage, lenders will run a credit check. They're going to look at your credit report, which is essentially like a school report. How well have you been behaved with your debt in the last 6 years? So they'll look at how much debt you've got, whether you've repaid that on time. If you haven't repaid it on time, is it a missed payment, default? Is it a CCJ? When was that satisfied, and what were the figures involved? The better your credit report is, the less of an issue you're going to have when it comes to accessing a mortgage. And also, in a lot of cases, the better deals you're going to be able to access. However, quite a big opinion that I have when it comes to credit scoring is that online and social media may have you believe that we all need a master plan with our credit score in order to buy a home. In my opinion, that's not the case. If you just have an amount of debt that is proportionate to your income, you have some borrowing history, and you've made all of your repayments on time, you will be able to access the vast majority of mortgage products when it comes to buying a home.
Yeah.
If we can just do those basics, that will leave you in a position where you're going to have no problems.
Yeah. And I appreciate you saying that, because it makes it seem like it's more straightforward for people to do if they don't need to, like, for example, get a crazy credit card or get a crazy loan or, like you say, it's like key things. And talking about key things, when it comes to your credit report, what should people really focus on to make sure should be in like the absolute best shape to give them like the best opportunity to be able to get like, a mortgage offer? Absolutely.
So, first of all, ideally, no missed payments. That's quite, plain and simple. That is for your communication agreements, utilities, credit cards, loans, car finance, whatever it may be. As well as that, your your level of debt. Okay. So lenders, when they run a credit check, will see how much debt you've got. They will then do something called a debt to income ratio check to check that the debt that you have is proportionate to your income. So just be wary of that. Most people will know when they've got too much debt. Okay. The amount of debt that you have should not be matching your income or anywhere near it. As well as that, credit utilization.
Yeah.
So credit utilization is how much of your available debt that you are using. So for example, if you've got credit cards with an available limit of £3,000 and you have a balance of £1,500, that's a 50% credit utilization. There's not really a hard and fast rule. Lenders don't publish what the rules are, but every lender's different. But if your credit utilization is too high, you absolutely can be declined for that reason.
Really?
On a mortgage. Yeah.
Oh my God. That's crazy. But they don't kind of give you information because I guess each one is different, right? So,
absolutely.
Okay. So let's talk about this in a hypothetical way, right? So like, let's say you're my mortgage advisor and I have this too high credit utilization, right? Let's say it's crazy, it's like 80%, right? And we've now settled on a lender that we're going to go to. I've got a great interest rate, right? And then we go to that lender and they say no, declined, right? Because your credit utilization is too hard. Working with you, what would you kind of advise me to do? What would be like the next steps for me in that situation?
So every lender's tolerance is different. So if we were declined first of all, we would not submit a mortgage application with a lender where it's going to be declined, because I would know whether or not that's going to be a problem before submission. Okay. But let's say if there was a lender whose criteria we didn't meet in terms of credit utilization, there's over 100 lenders on the market, each with a different tolerance. I would first of all look to move you to a different lender where it would fit. If it doesn't fit with anybody, it's time to decrease the credit utilization. Okay. So get rid of some of that debt.
Okay. That's sensible. And I like that because it gives people options, but also I think we're highlighting the fact that, look, your credit utilization is quite important, right? And I think it's also to protect you as well, right? Because if you then go and get like a mortgage and then you got all this debt, like you're gonna struggle, right? And we don't want that. So okay, that makes complete sense. And obviously, I think we spoke a little bit about this, about, you know, bad credit, CCJ, missed payments, right? What kind of impacts, you said that, you know, doing the repayments is a good thing. What's that kind of impact of somebody missing their payments or getting defaults or CCJs? How does that kind of impact their ability to be able to, you know, get a mortgage offer?
Yeah, so typically a default is more severe in the lender's eyes than a missed payment, and a CCJ is more severe again than a default.
Yeah.
Ideally, we won't have any, but lenders will look at the date that it occurred, the date that it was satisfied, the amount involved. So, for example, some lenders may have, you are allowed one CCJ in the last 6 years, as long as it wasn't not for more than £500. So there's quite a few different parts, and as well as that, how many events there are. Do you have one CCJ? Do you have two CCJs? But yeah, once you start having CCJs on your credit report, that's where things begin to get a little bit tricky.
Yeah.
But the more distance we have between them, the better.
So distance in terms of like when it happened and you settling it. Yeah. You know what's so crazy about CCJs? What I find hilarious about it, right, is that a lot of people have CCJs because of parking tickets. It's not even like they have CCJ because of like some loan somewhere. It's the parking ticket stuff. You know, that is, you know, when I we posted a clip about CCJs, and a lot of it was that. It was parking tickets, right? So how does a lender kind of see that, which is kind of, this is just my opinion, it's trivial. It's a parking ticket. It's not somebody's gone out and taken a loan and they've defaulted on the loan, and it's just a parking ticket that they did pay, or it got lost somewhere, blah blah. So how does the lender kind of see that?
Lenders, and on most occasions, are pretty black and white with it.
Okay.
It's a CCJ. When did it happen? Is it satisfied?
Wow.
How much was it for? But I would say you are right. On most occasions, it is things like parking. And I've had so many occasions where I've spoke to one of my home buyers and have said, it was me mum driving the car, whatever it was, but it's in their name. And they've maybe thought it isn't an issue because they've thought maybe it wasn't their fault and it was just a parking ticket. But it is an issue. And that's why it's important to have your credit report assessed early. So if these things that may appear trivial to you, you can find out, is that going to stop you doing something as big as buying a home?
Yeah. Can you imagine a parking ticket stopping you from buying a home? No.
It happens.
My God. That is terrible. For paying 60 quid or however, or 100, whatever. I mean, it's worth paying 100 for the ability to be able to get a property in the future. Oh my God. Okay. Buy now, pay later. That's another thing. And that's more recent. And I know now it's, you know, if you do use it, it's getting reported on, you know, people's credit reports. What's the impact there? Like, how does that impact, again, people's ability to be able to, you know, secure a mortgage?
Yeah, so Klarna was always the big one. Klarna wasn't, you know, your debt and your repayments for Klarna weren't reported within a credit report. I believe the date was the 1st of June 2022. Since then, it is reported within your credit report.
Yeah.
But what that means is, historically, some people maybe wouldn't respect that debt in terms of making the repayments on time.
Yeah.
It's only Klarna. Doesn't matter. But it does matter. That will show on your credit report like any other debt now. So you need to make sure you're making those repayments on time the same way you would a credit card or a loan or your car on finance.
Okay, so it's pretty much the same. It's treated the same as like if you did get a loan or credit card.
Absolutely.
That's crazy because buy now, pay later, right? It's it's got less friction. It's not like a loan where you have to fill it in. They're doing like credit checks and it's like, okay, you really sure you want this? You got to sign agreements. I've never really used buy now, pay later, so I don't like know, but it's I've seen it on checkout, so I'm sure it's a very simple process to just use whatever service, right, to do it. So okay, so it's very, very important. And this is the thing, right? Things like that, I'm sure there's people listening that have used buy now, pay later are probably like freaking out. So the thing is for you to just make sure that you're repaying it, you're not missing. Is missed payments on that getting reported as well?
Absolutely,
Really?
absolutely. I think the big thing is just avoiding unnecessary debt. naturally in life, a lot of people, you might get a car on finance, you might need a loan for something, you might have to do something on a credit card. Ideally, we want to keep that to a minimum, but where we can avoid unnecessary debt, you should do it. On buy now, you can get a kebab on buy now, pay later. It's just not necessary, is it? It's just not necessary.
Parking ticket or kebab is stopping you from getting your property. Is that what we want? Is that what we're saying? That is absolutely crazy. And I wanted to understand, right? Of course, there's one school of thought in terms of course, it's possible for you to get the mortgage offer.
Yeah.
But then in these kind of, let's say, these adverse situations, right, is what I think they call them. Like, say you got CCJ, missed payments, defaults, even though you've got the opportunity to get a mortgage offer, is it the fact that those mortgage offers could be, let's say, not a great one? Do you get what I'm trying to ask? Like, maybe the interest rate's a bit not the best because they know, okay, you're not I don't want to say ideal, but you've got these adverse situations, basically.
Absolutely, but it is a case of that. It is a case of lenders not viewing you as an ideal customer because they've got doubts of whether you're going to pay that remortgage, your mortgage on time. 99% of people, regardless of bad credit, can access some form of mortgage. It's more of a case of you may have to pay a larger deposit. You may have to pay higher interest rates. So you might not be able to access the best deals on the market. But what I would say is, if you do have an event of you have missed a payment here and there, that doesn't mean that you can't access the best deals either. The best way to understand your credit, in my opinion, is not to, download an app with a credit scoring master plan on. It's just to speak to a mortgage advisor. I look at credit reports every day. I can tell you within a few minutes what sort of impact your credit will have on your ability to buy a home. And ultimately, buying a home for most people is the ultimate financial goal.
Yeah.
It's that, or maybe buying a nice car. What else do you need such a good credit score for? So speak to an advisor, have it reviewed, get some clarity early. And you don't want to be playing guesswork with, the master plans that you might find online.
That's a good point, actually. You know what? You're absolutely right. Yeah, the good credit is really is for the property, really, or for some people the car, but it's really for your ability to access the huge finance that you'll use for property, which is true, or maybe business, but property. You're absolutely right, because that is a significant outlay, and you really want to kind of get that correct. Okay. As
well as that, some people sort of seem to want to improve the credit score for the sake of it. A lot of the time, if you've got no let's say you're a young person who doesn't have a large history of debt, but you've got no mispayments, because you maybe have a lack of history, your credit score might be a little bit average. But reality is that average credit score with no adverse history will allow you to access most mortgage products. Okay, so if that is the case and you can access the best deal with your average credit score, do you need to improve your credit score? Do you need to then start taking out the loan in order to build your score if you don't need to? And then once you get the mortgage and buy the home, you're going to be making those repayments, and that credit score is going to increase naturally anyway. So it's an understanding of, if you want to improve your credit score, understanding why it is. Is it because you need to buy a home? Yeah. And if it is because you want to buy a home, understand whether it's necessary. You don't want to take on debt if you don't need to.
Yeah. Okay, that's an important, I think, point, because you're absolutely right. Because when you do take on debt, that's taken away from your ability to even get the mortgage. So you're kind of in this kind of weird loop. So okay. But in terms of, let's say people do want to improve their score, and we're thinking maybe not for the people that are average, but maybe the people that maybe it's below average and they want to get to average, what kind of tips would you share with them around that?
So in some cases, let's imagine I've spoke to somebody, I've looked at their credit report, and I've decided on that occasion you do need to increase your borrowing history. Okay, if that is the case, on some occasions, taking out a form of debt, maybe your credit card, putting your groceries on, your petrol, and repaying that each month, that can help to build your score. Simply maintaining your regular payments and making sure all of those things are paid on time can help. Registering for the electoral roll can help improve your score. And making sure, again, things such as your credit utilization, your level of debt is under control. Those are the main things that are going to leave you in a strong position.
Yeah, okay. I like that, and I hope people are listening and taking notes on this, because I think this is very important, especially if you want to be buying your property this year or you're remortgaging as well. So obviously we understand that credit has like a very important impact on your ability to get a mortgage. What kind of other information is like central or almost as important for you to be able to get a mortgage?
Yeah, so lenders look at all sorts, but to name a few, that will be your level of income. In terms of affordability, lenders will also look at how many children you've got, the amount of debt that you've got. In terms of how much you can borrow, age can impact that. How long can you take a mortgage over? As well as that, whether or not you can access a 2-year fix or a 5-year fix or both. With some lenders, you can borrow more on a 5-year fix than a 2-year fix. But do you meet affordability for a 5-year fix? So lenders look at all sorts. Yeah, there's many things that they cover.
Yeah, I mean, you said a lot of interesting stuff that we're going to cover. But then you said a few things that I'm trying to remember it, that I've not really covered before. So you said obviously affordability. The children one, yeah, that was interesting.
Yeah. So
Interesting.
Children cost money. I've got I've got a 3-year-old and an 8-month-old, and children definitely cost money. So lenders factor that into your affordability. So it's different with every lender, okay? But having more children may decrease the amount that you can borrow for a mortgage. I'm sure that may not be paramount in your decision making when you're buying a home. But yeah, the more children you have, sometimes the less that you can borrow.
Yeah.
However, things such as child benefit can be used with some lenders for your income, to boost your income, as well as that if you're in receipt of child maintenance. Some lenders will accept that to boost your income. Okay. So children can actually play quite a big part.
Yeah. And let's stay on the topic of income, because I think that's very important, especially as like people can kind of get income from different ways, and the fact that income is what kind of almost determines like, what you can kind of get. So I think, many of us understand that if you have a 9-to-5, your 9-to-5 income can be used to get a mortgage offer. So let's talk about this, right? What's the range of, I want to say, income multiple? And when you're giving an answer, can you also explain what income multiple is, just in case people don't know what that is? What's the range that what can it kind of range from for somebody to be able to get a mortgage?
Okay, so most mortgage lenders on the market will borrow up to around about 4.5 times the income on the application. So if that's a joint application, 4.5 times the total income. Sole application, 4.5 times your income alone. Now that 4.5 times roughly is a maximum with most lenders. It will come down on that with debts, children, adverse credit history, things like that. So most lenders, 4.5 times your income. There are lenders at the moment who will go up until 6 times your income. Now, this is not for everybody. This specific product, it's quite a mainstream mortgage lender, will go up to 6 times your income. Now, this is for first-time buyers taking a 5-year fix who are employed, not self-employed. And the criteria, I believe, is £35,000 per year for a sole applicant, £55,000 for joint applicants can access 6 times
so
your
minimum
income.
Salary that you have to be earning. Wow.
Absolutely, as a minimum income to access this. Now, this doesn't mean that if you meet those criteria points, they're going to give you 6 times your income. That's just a new maximum. Your debts, children, credit history will all once again bring that down. But whether or not that's suitable really does again boil down to the individuals. 6 times your income is a lot. So we would consider things such as, do you maybe have a predictable increase in income? For example, if you're working for the police, there's quite a predictable pay scale. What does your general living expenditure look like? These are all things that we would consider. But just because you can access it, doesn't mean that it's necessarily suitable.
6 times is crazy. 4.5, I understand that. I think most people know that a lender would borrow to you like 4.5 times your salary, which makes absolute sense. And I think that's like the standard. But the 6 times is that's throwing me off, because I'm like, wow, like not even 5 or 5.5, like 6 times. That's crazy. That's a lot. So if you had like a 40k salary, that's like 240k. That's a lot. That's borrowing a lot.
So the things that we would
Wow.
explore, if there was an occasion where that was potentially suitable, for example, if you're buying in London, houses are expensive, so that can help. Things such as the mortgage term, so extending the length of your mortgage will bring down the monthly payment. So these are the things we would explore to see how suitable that would be.
Yeah.
So ideally, you might think, you know what, I would only want a 30-year mortgage term. However, if you're borrowing over 4.5 times, that might just not be affordable for you. So in that case, we may look at extending the mortgage term. Your mortgage might go on a little bit longer than you were hoping for, but it might give you access to a higher amount and a larger property.
Yeah. That's the thing. I mean, personally, for me, I don't think I'd ever get 6 times my salary. I think I would be putting myself in a lot of issues there. And like all you're doing is like you're working to pay off a mortgage, which you don't want to be, right? Like, I don't think you want to be in a situation. I think it's important, right, for people to kind of think about that. Because like you say, a lot of us have the aspiration of getting onto the property ladder. Well, I'm already, but a lot of people have the aspiration of getting onto the property ladder. However, it's like, is it by all means? Sometimes it's like, okay, I'm going to do the 6 so I can get onto it. I think it's a bit,
I agree. So with my house at the moment, this is our second home as a family. It's in the northeast. It's a 3-bedroom, semi-detached. It's got a garage conversion. It's got a little bit of an extension at the back. It's not it's a good family home. It's got a good back garden. And we have conversations with our partner about whether or not we would ever want to move again. And I'm quite cautious financially. I don't think I would ever want a larger mortgage than I've got now. Why? Because I don't really want any more financial stress than I've got now. You know, a lot of people in the UK, when you talk to friends, one of the main stresses in their house growing up is finances, whether it's with parents or their own finances. For me, I look at our house and I think, right, I like our neighbours. We've got a good back garden for the kids. We're safe. The kids are safe. We've got everything we need. Do I, even if it was possible, do I ever want, the 4-bed new build? Probably not for me. So you've really got to understand, what you're getting from the property. Is that enough? Is it worth it becoming a difficulty in your life?
Yeah. For me, I'm not gonna lie. I like you. I think about these things very carefully. The one thing for me is I never want to be in a position where it's like immediately 50% of my payment salary is going on to a mortgage. For me, I think that's way too high, and I think that would be way too much of a struggle, because like if interest rates increased even more, let's say, it's probably unlikely, but if they did, then it would be an issue. And interest rates did, for me, they increased a lot. Like we were talking about, I think I was in the 3%, and then now it's like in the 5%. So we're talking about almost double. But I've been able to afford it because when I first got my property, I didn't go too crazy. It wasn't too gun-ho. It wasn't like, okay, and then when my salary increased, I wasn't like, okay, now I'm going to try and jump onto somewhere else. Yeah. For me, it's like, oh, my salary's increased. Okay, more money in my pocket, right? So I think you got to be very mindful, because a mortgage, you're going to be paying for like 20, 30 years, and you don't really want to have this thing, like you say, financial stress hanging over your head because you've made that kind of decision, right? I think it's,
Yeah, I completely agree. I think it's just a case of weighing up your priorities. How much is it going to cost on a monthly basis, and weigh that up with, do you still want to, do you want to go and be able to go on a summer holiday? Do you want to be able to, simple things like, do you want to be able to go out to a restaurant once or twice a month? And weighing that up with the monthly mortgage payment to make sure your life remains what you want it to be.
Yeah. Amazing. Okay, so let's talk about this. This is interesting, right? The income element. So we talked about the 9 to 5 income. I think that makes sense. We know that your 9 to 5 can be used 4.5 times, right? Your salary, in terms of like potential, like what your borrowing be. But you can get income from other things. So you can get income from your stock investments, crypto. If you sell, get income. Potentially a pension in a way, right? Property. So there's income. There's several ways you can kind of get income. How is those things that I've kind of mentioned? We'll talk about business separately, because I've got another question about business and side hustles. How does that kind of impact, like, the potential borrowing and, like, again, get your mortgage?
Okay, so we can start on crypto. Yeah. So, there's the 2 aspects to look at. Can you use crypto as an income source for a mortgage? Can you use it for a deposit? Currently, as an income source, no. Okay. However, the world's changing. Lenders are opening up. Who knows? As a deposit source, crypto, there are now some lenders that will accept that. Now, when applying for a mortgage, they want to see that the money that you're going to use for your deposit is readily available at the point of application. So most, they're not going to want it held in your crypto account because that could disappear tomorrow. But if you've pulled that money out of a crypto account, there are now some lenders who are willing to consider that as a deposit source.
That's interesting. Crypto. Who would have thought of the day? Oh, okay. So if you've got them good crypto investments, you can kind of use it as like a deposit. And then what about like stocks and shares? How's that? That's obviously stocks and shares is more, I guess it's more, it's been around for a lot longer, right? So how's that treated? Can that be used for income if you sold your stocks and shares? If you got dividend from that, I guess, can that be used?
Yes. So if it's reported within your tax calculation as dividends, yes.
Okay.
That would just be classed as sort of the same way as self-employed income would. As a deposit source, again, most lenders will want it to be held sort of out of an investment account at the time of an application, because then the funds they're not going to change. They're in your savings account. Lenders know it's there ready for the purchase.
Yeah, that makes sense. And then what about like property? Because some people have, like, of course, you said you got your second property. What about like, if you've got a property that you're getting rental income from, do they use that? Would they kind of,
Absolutely. So quite often, so property income could be used either as a primary income source or as a secondary income source. Again, it would be classed as self-employed income. So it would be, your limited company tax returns, or it would be your tax calculation or self-assessment. Lenders will consider that. If most lenders will want to see 2 years history, a profit from property. But if you have that, absolutely that can be used for a mortgage. That's
interesting, because I'm thinking, of course, like some people have their job. So if I use you as an example, right? Or if I use me, I can use me as an example. So I've got obviously I got my 9-to-5 job. Let's say I had like a second rental income, right? And obviously I'm using my 9-to-5 as my primary, but I wanted to add, like, I've got the rental income to like boost to get a bigger mortgage. Are you saying that I'll still be kind of classified as self-employed in a way, in that kind of situation?
Income would be your self-employed income would be that comes from property.
Okay.
But if you can provide the evidence in terms of your tax calculations, for example, to an appropriate lender, then you can use that to boost your income for a mortgage application. It's quite common.
Okay, cool. And is all of those situations, right? So we talked about crypto being used for deposit, stocks and shares, property. That's okay to property, I guess. If you're going to sell it for deposit, it makes sense. I think I'm comfortable with that. Stocks and shares, though, do they see that as you could use that as a form of deposit if you?
Very common. Yeah. Very common. I would say it happens all of the time. So if that's where your deposit is held, no problems. You just need to consider whether you need to pull that out of whatever. It depends on the account. Whether you need to pull that out of the investment account, so lenders are more satisfied that investment's not going to, the stocks and shares aren't going to go downhill before the purchase completes.
Okay. Cool. Look, this is so interesting because we're tying in everything, because, some people that listen to the podcast, they will have investments in crypto. They will have, property investments. They will have stock investments, stock and shares investments. So it's nice to hear how you can kind of use that to get yourself onto the property ladder and have some clarity around that. Because I guess, to be fair, I don't think I really spoke about that on the podcast. So it's very interesting to know what could be used for income, what could be used for deposit. Side hustles, of course, I think more and more people are adopting side hustles, of course, because they want to make more money and stuff like that. How is that kind of seen, I guess, in terms of you're looking to like get onto the property ladder and get a mortgage?
So the first question would be, are you paying tax on it? Your side hustle. If you are paying tax on it and submitting your accounts, then again, you'll be getting your self-employed documentation through for that. If it is a side hustle, it will be classed as a second job. And the way that lenders consider second jobs differs from lender to lender. But But yeah, some lenders will use 100% of that second job. Some will use as low as 40% of that second job. But yeah, it would be a case of, can you evidence, in the form of tax calculations again, for example, can you provide that evidence? If you can, then a side hustle income, at that point, it may be classed as a second job, can be used. But if you've not got to that stage yet, you're not, submitting accounts and paying tax on it, then no, we can't use it as an income source, but you can use it as a deposit.
Interesting. Wait, okay, so is in terms of if you're not like, I don't know how to say, if you're not like doing your side hustles like, not that it's not official, sorry, it's legal, but it's not like sole trader. You're not like a sole trader or something like that on the side. You're just maybe reporting it on your self-assessment and stuff like that. But you're saying if you do that, you can use it as a deposit.
Absolutely.
Okay.
Well, no, even if you're not doing that, you can still use it as a deposit.
Okay.
There's a certain threshold with the bright lights on, I'm forgetting the figure, where you don't have to pay tax on a side hustle. You can earn up to a certain amount.
I think, is it $1,000 off the top of my head?
That's what I think it is.
Yeah, I think it's $1,000. I'll have to correct myself offline. I'm pretty sure it's...
Absolutely. So, if your income, if you are generating income from that income, if it's held in your bank account, can be used for a deposit. That's not a problem. But if we're not paying tax on it, we're not submitting accounts, you can't use it for your mortgage affordability.
Okay, cool. So then, on the other hand, right, are there any income sources that lenders are like, nah, we're not going to use this? Any other things that you can think of?
So income sources, crypto is a big one.
Yeah.
Income sources still. That's a big one, but lenders are pretty good. Lenders will consider a lot, whether it's bonuses, overtime, commissions, shift allowances. Lenders will consider a lot.
Okay, so they take a lot. Okay, cool. But then what about on the deposit side? Is there anything that they won't consider for like deposits as well?
It's more so that lenders want to be able to evidence your deposit. They want to see, at least a 3-month paper trail of where that deposits came from. So you need to be, that's the key factor. We need to be able to evidence, where the monies came from. Yeah. But with crypto, if you are thinking of using some proceeds of crypto for your mortgage deposit, then you need to work with an advisor, because most lenders won't accept it. There are those that will consider it. So you need to speak with somebody who's going to be able to point you in the right direction and place you with the correct lender. Okay,
that's cool, because look, a lot more people are going to be investing in crypto for sure, and I'm sure in the next 10 years it's going to be so normal for people to sell proceeds to be able to buy themselves something. Okay, cool. And then you mentioned bonus, right? I remember when I was going through my mortgage process, that they mentioned to me that you can use your bonuses as part of your your income, in terms of like what it is, in terms of them saying 4.5 times your income. How does the bonus kind of work? Can you talk to me around how lenders potentially look at like bonuses in that kind of situation? So bonuses from employment may be received monthly, half annually, or annually. Let's look at annually. If it is annually, most lenders want to see a history of 2 years. Most lenders will take an average of your latest 2 years annual bonus if it is increasing and use that figure. There are lenders that will accept only 1 year's annual bonus. A lender that springs to mind for that, if you only have 1 year, they will half that amount, but then you can use that towards your affordability. If it's a monthly bonus, then lenders will typically look at your latest 3 months, check that amount is in line with your year-to-date figure on your payslip. And if it's half annually, many lenders will want to see 4 bonuses. Okay, that's wow. So there's a lot of rules around it, but it's quite clear that you can definitely use your bonus for it. Okay, so that's quite important, because I think this also helps people understand like affordability. And talking about affordability, how do lenders kind of determine how much somebody can kind of afford? I think that would be interesting for people to understand. So lenders look at income, debts, children, the mortgage term you can access, whether you have good credit history, whether it's a 2-year fix, a 5-year fix, a variable rate. That will all give us a different borrowing amount. The important thing to remember is that every lender will give us a different borrowing amount. So maybe if you can't access the loan amount with one lender, that doesn't mean that you can't access the loan amount that you need
with another. Lenders have some fantastic affordability calculators on their websites. And if you're looking to buy a home, even if you're just interested and you're years away, you can play about with those calculators, see what does your income need to be, where does your debt need to be, to make sure that you're preparing early.
Yeah. And I guess what things would impact someone's affordability? I think we mentioned some of it, which we talked a lot about debt.
Yeah.
But what other things could kind of impact? And you mentioned children as well. What other things can kind of impact like how a lender sees you in terms of like affordability?
Yeah, so lenders' mortgage products, so whether it's we'll use a 2-year fix and a 5-year fix as an example, many lenders will give you a different maximum borrowing amount depending on the product that you choose. So if you are running affordability for a 2-year fix, and maybe it's not quite fitting, if you explore a 5-year fix, you might be able to meet affordability. As well as that, the length of your mortgage. With some lenders, if you take a mortgage over a longer period, they will give you a higher loan amount. One of the reasons being that it's a lower monthly payment. Lenders are considering what the maximum monthly payment is that you can access. So it's not only the loan amount that you're accessing, it's also the monthly payment that they are willing to grant you.
Yeah, amazing. And I wanted to talk about this because we did speak about this offline, and I think it's a very interesting viewpoint as well, which is pensions, right? Investing in your pensions, how can that impact your affordability in a lender's eye? Let's say like somebody investing 5% versus 15%. Can that have an impact on somebody's affordability?
On most occasions, your pension contributions within your payslip, so through your employer, on most occasions, that will not have too great of an impact on how much you can borrow. When you begin investing into private pensions, that can begin to have a little bit of a bigger impact. For example, if you are self-employed and you are paying into a private pension, if that's the case, that will be factored into affordability, and that can impact how much you can borrow. Okay,
wow. So that actually does, but it's more, like you say, it's not really the workplace pension. It's more if you're getting your private pension. So this is where it becomes so interesting because people are going to be investing in private pensions because I think it's still like is a good wealth building tool, right? But when you're doing that, it could take away from you getting a property. So this is why holistically you have to kind of do all of this. All of these things are kind of linked basically in one way or another. It's not like one thing. If you do one thing, it impacts the other thing. But you know what? I never really thought that pensions, like something like pensions, could potentially like impact your ability to, borrow car finance. That is popular. A lot of people have car finances. There are people who will probably have a car finance, and I'm not judging anybody. I'm just stating opinion here. So there's going to be some people who may have a car finance, maybe half what their salary is. That happens. How is that looked at on your affordability? Basically, I want to understand that part.
So let's imagine that the balance or the amount of the debt in total is proportionate to income, and that's not an issue. Lenders will look at the monthly payment, and the monthly payment is more of a factor of, in terms of what will impact how much you can borrow. But your car finance is so important. The headlines that we see on the news are, will buying a coffee, will the amount of coffee that you're buying impact your ability to buy a home? With coffee, let's imagine you're not taking out any debt to buy your coffee, which I hope people aren't. But let's imagine you're spending quite a lot on coffee.
Yeah.
Could that be better placed in a lifetime ISA? Yes, probably. However, the money that you're paying for coffee and your general living expenditure, as long as you're not in your overdraft or you're taking on debt, that will not impact how much you can borrow for a mortgage. So let's say you're paying £300 per month on coffee. Okay, that amount will not impact how much you can borrow for a mortgage, as long as there's no signs of financial distress. For car finance, let's imagine that you're paying £300 more than what you need to be for your car finance. That's quite a significant amount, and that's going to impact how much you can borrow for a mortgage. Reason being, that's a committed expense. That's an expense that you've committed to. So a conversation we have a lot of the time with people who are maybe struggling to meet affordability, and I see a lot of car finance agreements, I see a lot of expensive ones, is How much do you really want that nice expensive car? Is it really that important to you? You know, even with friends and people who I know in the local area I'm from, I know people aren't even that interested in cars, but they've got a huge car finance agreement.
Seriously?
Which is impacting how much you can borrow for a mortgage, how much money they've got left at the end of the month. So yeah, instead of looking towards how much you're spending on coffee, before that, look towards your larger debts and your larger commitments, such as your car finance. That's always the most important starting point.
Yeah. And this is the thing. I'm glad that you say that, because the advice about stop like eating avocados or toast and coffee, you're right. The car finance is way more important.
Yeah.
It's a way more important factor that actually none of these people that say all this stuff ever talk about. They never talk about that side, which is actually the real problem, is the car finance. That's the big issue. And I'm not like judging people on, it is what it is. You have to make the choices that are right for you. And if you love a car, that's for you, right? But I'm glad that you spoke about that, because I think it puts into context. I think sometimes, unfortunately, we have to make a choice of what's a priority for us. Is getting onto the property ladder a priority, or is having a nice car a priority? In some situations, you can get both, but what order do you want to do it? Do you want to get the house first, then you get a nice car? A lot of people do it the car way first.
Yeah.
They get the really nice car first, and it's like, oh, I'm not on the property ladder. Oh, I want to get in a property, but I can't. But it's because you've got the nice car, So yeah, it's very interesting. And I remember I posted a clip, actually. Was it last year? And we were talking about like, my guest was talking about like investing in property versus getting like a Range Rover. And a lot of people saying, oh, it's easier to get car finance, which is true. It is easier to get car finance. But I think, again, it's still priorities. What's more important, right? It's up to you to decide what that is. So not everyone can obviously get the same length of mortgage. How does the lender kind of determine, the term length of your mortgage?
So most lenders will go up to either 70 or 75 for a residential mortgage. That's most lenders. Okay. And most lenders will have a maximum term of 40 years. So the maximum term you can take is over 40 years. The longer your mortgage term, the lower your monthly payment. However, you will pay interest over a longer period if you never change it. Something to bear in mind is you can change that in future. You're not necessarily stuck with that forever. But yeah, typically the longer the mortgage term, the more some lenders will allow you to borrow. Something that we see more of at the moment, I would say in the current market, is there's a lot of fear around finances at the moment, I would say. And this is leading to people taking longer mortgage terms, which isn't, people speak about doing this sometimes as if it's the worst thing you can do, taking a 40-year mortgage, for example. Obviously, ideally, we would all be mortgage free in 25 years, but quite often that isn't the case. What a lot of people do is take the longest mortgage term that they can, and that means that they are committed to a lower monthly payment, and then choose to make a regular overpayment, which would match a 30-year term, for example. That means they are going to be mortgage free sooner if they keep that up. But if things get hard, they can cancel the overpayment, and they've only got the lower payment there that they are committed to.
Yeah.
So the little things you can do like that can help to make life easier, again, where suitable.
Yeah. And thank you for mentioning that, because absolutely, you're right. The overpayment thing is important, and people can kind of do that, as you say, and they're able to like reduce like the amount of time, how long it'll take for them to get mortgage free. And the thing is, right, like for you being younger, it's interesting, right? The fact that you could, did you say 40? 40, you
40.
can get a 40-year mortgage?
Yes.
I didn't know that. I thought the longest was 35.
Some lenders it is, other lenders it's 40. But one of a big bit of advice that we hear from parents, I work with a lot of young first-time buyers, and parents might say, don't take a mortgage over 25 years. However, reality is that house prices are a lot more expensive now than they maybe were when your parents bought a home. And in an ideal world, yes, we would not take a mortgage for more than 25 years. But in some cases, it is necessary. So, everybody's situation is different. If we do need to take a longer mortgage term, there's nothing wrong with that, as long as you're comfortable with what it means, the monthly payment's affordable, and if it's the right decision for you.
Yeah. And that's the thing. If it does make it more affordable, and like you say, then you get to a point where maybe like a year down the line, your salary's increased or your income's increased from other sources, and like you say, you're able to overpay to maybe match if you like somebody that maybe had the same similar situation to you and it was actually 25 years. You have the kind of you have the breathing room to be able to do that. You have the flexibility to do that. So yeah, that's quite interesting. And I guess for people who are a bit older, right? You said that it's up to 75 and it's not beyond that. The length of term is very...
It can go beyond that with some lenders.
Okay.
But I would say with most lenders, you're looking at 75 or 70.
Yeah. And I guess with people in those situations, right, where it's like, it's only a 10, 15-year mortgage, I guess how would you what kind of conversation would you have with them about something like that? Yeah.
So I get asked a lot by people, am I too old to buy a home now? The answer is no. But if you are restricted with your mortgage term, that will just mean a higher monthly payment. So we need to establish whether, one, you're comfortable with that, two, whether in reality it is affordable. If somebody does need to borrow past at your typical age of 65, 70, 75, or if you need to borrow into retirement, you know, lenders do start looking at things such as pension income. Can you evidence what your pension income is? If you can, then yeah, perhaps we could use that as an income source. Okay.
So pension could potentially be used as an income source as well. Okay. That's very interesting. Okay. Look, these things are important. This is why you gotta get this stuff right now, because they're so important. Like, and we are not taught this. So it's incredible. They're expecting people to kind of navigate all of these intricacies, you know. And the thing about mortgages, there's so much to it. Like, oh gosh. Well, that's why we have you on the podcast, right? So we can ask these questions. So self-employed, right? So some of our, you know, audience, are self-employed or they have their own kind of businesses, right? And let's say they want to be able to get a mortgage. How does that kind of differ from, you know, somebody who's like a 9 to 5? You did mention 2 years of accounts. Can you kind of talk about that, like at a high level?
Yes. So there's a little bit of a myth that there are self-employed mortgage products. There aren't. Self-employed applicants have access to the same mortgage products as employed applicants. It's just that the evidence that they need to provide is a little bit different. For example, many lenders would wish for a self-employed applicant to be able to evidence their income over the latest 2 years. Rightly or wrongly, this is because the lenders deem that income to be less reliable, more unstable, maybe have more variation.
Yeah.
So many lenders will want to see the latest 2 years. Okay. There are lenders that will accept one. I'll come back to that later. Okay. But of the lenders who want to see 2 years, let's imagine you're a limited company director. Some lenders will use your salary and dividends from your tax calculation. Other lenders will use your salary and your share of the company net profit from those limited company accounts. Let's imagine they are increasing. Most lenders will use an average of your latest 2 years. Some will use the latest year, but it's on less occasions. Yeah. So it's my job as a mortgage advisor to get all of that documentation in, look at the figures, salary, dividends, and your share of the net profit, and then decide which lender you will be best placed with, who will make the best use of your income. Now, of the lenders who will accept 1 year's income, that is possible. Some lenders do it. It's not for everybody. Of the lenders who will do it, they consider things such as your history in that line of work. Have you had previous success in that line of work? What are the predictions for the next year from your accountant? So I'll use an example. I had a client last year who he had a business where he sold fish en masse. So he sold fish to Taylor Swift's concerts. That's what his business is. But he only had 1 year's accounts when he worked with me. So could he get a mortgage? Yes, he could. Reason being, he was able to evidence a long history in the industry, an award-winning chef, an award-winning supplier. Okay. He'd worked in all of these amazing restaurants around the world. And all of this was genuine information that I gathered to pass on to the lender. And that lender was happy to accept 1 year's accounts with a prediction from the accountant of what they were going to achieve the following year. Okay. So it is possible with the right circumstances.
Okay, interesting. So that is so interesting because it's like that person basically saying what the lender is saying, because this person has track record, it's likely that the business is going to be growing because of their reputation, their track record of doing what they're doing. That is so interesting. So I guess with the 1 year is about, do you have that credibility? Do you have that track record of doing, even though maybe you're new in business, is your business based on what you've been doing professionally? And it's not just some random business that you just kind of maybe just started up to try and, I don't know, fake getting a mortgage and stuff like that, or mortgage or do like mortgage fraud. Talking about mortgage fraud, actually, now that we're on that topic, how does that happen? The whole mortgage fraud and things like that. Like, how can people, I guess, avoid that?
How can people avoid mortgage fraud? Do you mean how can innocent people not be accused of mortgage fraud?
Sorry, not to, exactly.
To avoid complications and stress that you maybe don't want. So an example of that is making sure that the pay slips you're receiving from your employer match the salary that you are receiving into your bank statements. Lenders do check those things, but if they are, if the things don't match, lenders will have questions. If you're providing 3 months pay slips that show you earn £10,000 a month, but the money going into your bank shows that you only earn £2,000 a month, lenders are going to have questions. And, let's say that this is somebody who their employee is making a mistake on the pay slips, but those sorts of mistakes will begin to raise questions.
Okay, cool. Okay, that makes sense. Yeah, no, sorry. We're not trying to get people to do fraud. No way, no. It's more like, how do people kind of ensure that they do not do that or attempt to do that? That's what it was. It was more like that. But yeah, thanks for answering. I think it demystifies a lot of, in terms of like, for self-employed people, that it is possible for them to, get onto the property ladder. What I was thinking while we was talking about that, right, is, this is just my opinion, right? I think if somebody has a 9 to 5 and they've got a nice side hustle, like generating some money, they could potentially use the income to get their mortgage and then the side hustle, and then combine some of, the proceeds or maybe savings that they've got from their job as part of a deposit, plus some of the, side hustle stuff as a deposit to get a house, and then, do repayments. I think that's quite smart, because you've got your 9 to 5, which is stable. Because do lenders, even if you've been at a company for a few months, do they care about that kind of stuff? Like if it's a new company?
So every lender is different in terms of what track history of employment they want. There are lenders that will accept, even if you haven't started a new job, just an employment contract if it's due to start within the next 3 months. So yeah, switching jobs is not as much of an issue as you may think. But if you are planning on switching jobs, starting a new company, just run it by your mortgage advisor. Your mortgage advisor is not a career advisor, but they can let you know if you do take that gap in employment perhaps, or if you do switch from this industry to that industry, how that will impact your borrowing, or if it will. But just to quickly dial back to the mortgage fraud thing, if you are considering lying about your circumstances for a mortgage, you will be caught. You will be.
You will be.
Mortgage lenders aren't silly. So first of all, mortgage advisors like myself, I would never, ever, ever work with anybody who isn't doing things correctly. It's my business. It's my life. I don't need that sort of business. Most mortgage advisors, I would like to think, would never touch that. But then secondly, lenders are running credit checks. They are checking pay slips. They are asking for bank statements. They are running ID checks. The chance of success, very, very minimal. So don't do it.
Do not do it. Just do it legit. Let's not try and do all of this, around the houses or shortcuts. Let's just try and do things the normal way. And there's so many routes to get it, right? Like if you want to do the business way, if you want to do the side hustle way, if you want to combine 9 to 5 business, you can do it. You've got investments. So there's lots of routes to do this in a legitimate way for you to get onto the ladder, right? So, okay. So I wanted to ask you this, right? So we mentioned the 1 year, the 2 years, right? The 1 year versus the 2 year, for example, or however amount of years that you've been in business, does that have an impact on like the interest rate somebody's potentially offered? I know it can differ from lender to lender, but generally speaking,
it can do, because if you only have 1 year's accounts, you will have access to a much smaller pool of lenders. Therefore, the chance of that being the best deal on the market is much smaller. With 2 years accounts, The vast majority of lenders on the market will accept that. Therefore, imagining everything else adds up on the case, you're going to be able to access the best deals.
Yeah. Okay. That, I think that makes sense. And so it's, again, we're talking about track record. We're talking about stability. It sounds like lenders, that's what they value. That's what they like.
Yeah.
If they see that, they're like, we can trust you more. So we will, we'll give you a better rate, basically. Okay. That makes sense. Talking about interest rates, right? I'm sure anybody that's listening on the podcast, even me, we want to get the best interest rates. What things can we do to give us the best chance of, landing, the best interest rate possible for us?
Yeah, so my job as a mortgage advisor, I'm a whole of market mortgage advisor. What that means is I work with the whole of the market. So all banks, all building societies. It's literally my job to make sure you get the best possible deal. That is what my job is. If you are only, let's say you're going directly and you're approaching 1, 2, 3 banks or building societies, might you get the cheapest deal on the market? Potentially. But even if you were, you might not be sure about it. And you might not. You might be, let's say you avoid paying a mortgage advice fee just to go direct to your bank. It could end up costing a lot more in terms of proceeding with a higher interest rate than what you need to. So just exploring all options to make sure you're saving money where you can, because household ownership is expensive. Mortgages are expensive. If you can get a better deal via a mortgage advisor for the bank down the road, it's well worth going to the bank down the road. Yeah,
and we're going to talk definitely about how you can find a good mortgage advisor for yourself, because I think that's definitely important. I mean, I used a mortgage advisor. I wasn't going to go through myself. It didn't make no sense. Why would I do all of that when you got somebody that could be working for you? They could advise you. They've got your corner. They've got your back, and they're going to try and do the best for you, right? I think it only makes sense. And even when you do pay a fee, what's the rough fee again? It's not even that. We're not talking crazy money here for it.
Residential mortgages in the UK, I would say the fee varies anywhere between £0 and £1,000.
Yeah.
Where that fee is payable is different from advisor to advisor. Yeah. So some may charge up front, some may charge on decision in principle, mortgage offer, or on completion, or a breakdown of multiple fees within that. So yeah, it depends on the advisor. But yeah, the saving that you can make on a lower interest rate or a fee-free mortgage product, you can make quite a significant saving.
Yeah, I mean, look, if you're buying a property we're talking about hundreds of thousands of pounds here, right? 500 to 1,000 to get somebody to help you secure the best interest rate is a small.
I think a major offering is peace of mind. There's so much bad news on the television. There's so much misinformation online. In this day and age, especially our generation, I would say we are less trusting of the information on the news. Stephen Bartlett's podcast recently has been under fire for misinformation on certain subjects. TikTok obviously has misinformation on certain subjects. I think more so than ever now, our generation are questioning the information that's out there, and therefore working with an advisor is becoming more and more appealing. I think even with the rise of AI, where you may think maybe these things could be automated and working with an advisor isn't necessary, I think it's becoming more and more popular. Advice, whether it's mortgage advice or financial advice, is becoming more personal. It's becoming more relationship based.
Yeah, I completely agree. And for me, like I said, I would always continue using a mortgage advisor. And the funny thing is, when I did go for my mortgage, I did try the AI thing. There was a few back then. When I say AI, it was online mortgages where you could do a chat and then they'll search and find. But I just still prefer speaking to somebody, because it's such. There's no knock on that. If people want to use that, that's up to them. I mean, personally, for me, I was like, this is my first purchase. I want to speak to somebody. I want to know if I've got any questions, I can speak to them. I can meet them if I need to. They can call me and whatnot. It was just a big purchase. So I think it was very important to be able to do that. So I've spoken to a few people, right, that, they've got like a few buy-to-let investments, and they're struggling with it, as rightly so, because of the interest rates kind of happening. The interest rates have increased a lot. So for some of them, it's like, it's almost not worth it anymore. So they're looking to now like kind of sell, right? So with those kind of people in mind, I was thinking, what can they kind of do? What are like possible options for them? You know, these people that are, you know, they're landlords, maybe they've got another property. They used to make money on it, but now the interest rates has gone up. No longer make money.
So it's always speak to your mortgage lender and understand what they can offer to help you. Is it possible for a break in payments for a short period? Is that an option? Secondly, let's imagine this landlord is on a repayment mortgage. Will your lender allow you to switch that to an interest-only mortgage, therefore reducing the monthly payment? You might not be repaying the debt anymore. However, that's, you know, something that we've got to weigh up. As well as that, extending the mortgage term. Can you extend the mortgage term to bring that monthly payment down? Have a chat with your lender, understand if they can help you, how they can help you, and then, yeah, hopefully there's a solution there for you.
Yeah.
Or sell the property.
Yeah. I know. I'm thinking a lot of people will be considering selling the property, but then it's like it's an asset. And imagine you've had it for years, and now you're like, I'm gonna, you know, sell it. It's quite sad, right? Because you put in all this hard work just for interest rates to be like, nah, you know, for somebody else to potentially go and buy it. But so it's a tough one. So, like I said, my remortgage is potentially happening this year. Lots of people are thinking of remortgaging. I guess what are the things that they should consider and look for?
So if your current deal is due to expire within the next 6 months, you can now secure your next deal. So yeah, you can secure your next deal within 6 months of your current deal ending. Okay. Reason being, a mortgage offer is valid for 6 months. Okay. So what I would do with my clients who I have, if they are due to remortgage, I would contact them. It would be within my diary to contact them 6 months prior to that expiry date. At that time, we can begin to start the process of securing a new deal. Reason being, at the end of your fix, if you don't do anything, you will move on to the lender's standard variable rate, which is very expensive, could be upwards of 8%. We don't want that. Okay, so what most people will do, imagining that you are staying in the property, is move on to a new fixed deal. You can either complete a rate switch with your current lender or a full remortgage with a new lender. What's more suitable for you depends on how much you fancy the hassle, and also what is the best financial solution. So with my clients, we'd weigh up both options. Is there any saving moving elsewhere? If there is a saving moving elsewhere, how much is that saving? Is it worth paying an advice fee? Is it worth paying a solicitor fee? Is it worth the hassle? Or do you just want to switch with your current lender?
Yeah.
Something to note is, if you do switch 6 months ahead, you may be worried about what if rates come down over the next 6 months. If you secure your next deal early, and then in the next 6 months, your lender reduces their rates, it's a very simple process with most lenders to just switch yourself onto the lower rates that become available.
Okay.
So yeah, secure your deal early, and if anything better becomes available with that lender, hopefully you can switch.
Yeah. Okay. That makes sense. You know what's crazy, right? I've been in this kind of situation. Look, I'm not gonna lie. Sometimes when it comes to the switching thing, I'm just a bit lazy. I'm just like, I'm just gonna stay on the same lender, right? If you did want to switch, if somebody did want to switch, what's from one lender to another? What's like the work involved in doing that?
So it's more so that there will be a transaction of funds between lenders. Therefore, you'll need a solicitor to complete that.
Oh, okay.
If that is the case, you're going to have to pay a solicitor fee. Could be £500. So you've got to weigh up the pros and cons of that. As well as that, so what I do with my clients is I can process a rate switch with my clients. It's a very simple process at my end. I don't charge a fee for that. If it's a full remortgage, I would charge a fee. Reason being, that's new research of the market. There's a lot more work involved.
Yeah.
So if somebody was working with myself, you just weigh up, what are the potential savings, all things considered, mortgage products, solicitor fees, my fees, what are the potential savings? And a lot of the time, can you be bothered?
Yeah, that's the thing. I'm not bothered.
That's fine.
Honestly, no, because it's like if the savings not enough, if it's like £50, you're like, really, I'm gonna go through all this hassle, paperwork, all of this, making calls for an extra £50 saving. Not to say that's not decent. That is decent, but it's also, you have to do way up. Like, it's a lot of time spent and a lot of, let me not say a lot of time spent, but it's like, could I be spending my time doing other stuff? I do my remortgage. I've got, it's a good rate, it's a decent rate. I like the rate. I like the lenders, easy.
That's quite common. I would say it's more common with my clients that will end up completing the rate switch and sticking with the current lender.
Yeah.
That is more common than a full remortgage at the moment.
Yeah. I mean, it's because it's like the hassle of doing it. We don't want the hassle of doing it, right? Like especially if it's a huge difference, we're talking like a few £100, then it's worth it, right? You gotta like kind of do it in that kind of situation. Okay. So is there any benefits, right, for existing customers that have been doing, like, they've had a mortgage for a while? Is there any kind of benefits that they get for having a mortgage for a while? It's just something I was kind of like thinking about.
So if you are coming to remortgage or to complete a rate switch with your current lender, sometimes they may have better deals for current customers. I would say they're not always fantastic. It's not always a huge difference. But some lenders may offer you a better deal or a fee-free deal if that's the case. One of the big benefits of sticking with your current lender is that a lot of the time they won't run a credit check. Therefore, that's something that you don't have to worry about.
Yeah, and that's important. I think that's the other hassle, right? Is running the credit check, is doing all this paperwork. You're like, oh, really? For like, £50 saving, are we really doing all of this stuff? It's important. So one of the big changes that's happening this year is stamp duty changes, right? That are going to be coming into effect in April 2025 of this year, right? Or April of this year, should I say. What are these stamp duty changes, and how do they impact first-time buyers and existing homeowners?
Yeah, so in 2022, the thresholds for paying stamp duty were increased with the aim of lessening how much stamp duty people were paying, therefore stimulating the market. It was always the plan that those changes were due to reverse on the 31st of March 2025, a date that we are now approaching, and those changes are being reversed as planned. So for a first-time buyer, as of today, in January, the first-time buyers are entitled to something called first-time buyer relief on their stamp duty. Currently, that is up to £425,000. As of the 31st of March 2025, that goes down to £300,000. So to let you know what sort of difference that makes. So if somebody is completing the purchase of a property of £425,000, depending on whether or not they complete before or after the 31st of March, could make a difference in stamp duty of £6,250, which is significant for anybody. That's a large chunk of a deposit. So if you do have a purchase that is ongoing, you need to be speaking to your solicitor and understanding, are you going to meet that deadline? And if you're not going to meet that deadline, where's the money coming from? Do you have that available? For existing homeowners, the stamp duty threshold, if you are looking to move home, the nil rate threshold, as we call it, is currently £250,000, reducing to £125,000 on the same date.
Okay, wow. So let's say people aren't able to get their property before April, which is only in a few months. Post-April, I guess, what can they do if they are buying property in post-April? What do they need to think about and consider?
Save more money for stamp duty. To be honest, there's not really many ways that you can avoid it. If you haven't started a purchase yet, it is highly likely that you will be paying the stamp duty figure, the higher stamp duty figure. Unfortunately, purchases are typically running on for longer than 2 or 3 months. But the date that is important for stamp duty is your completion date. It's not the date in which you receive your mortgage offer. It's not the date in which you exchange contracts. It's your completion date that matters.
Okay. So the completion date is what determines whether you'll pay this, potentially pay this, new stamp duty charge, basically. So if the completion is before April, then you're fine. If it's after, potentially you may have to pay something. Depending
on the figures, you may have to pay more. Depends on the purchase price. But just to give a little bit of a silver lining, some estate agents have reported that because so many people are trying to beat the deadline, arguably in some areas, on some properties, the purchase price is actually being pushed up because so many people are trying to beat that deadline, creating sort of a bit of an unnatural rise in the price of that property after the change as of April. Hopefully that will slow down, and property prices may come down slightly because people aren't rushing anymore.
Yeah, okay, that makes sense. I would have thought that the opposite might have happened, but yeah, I think that kind of makes sense in terms of the fact that I guess people are, they understand that people are trying to get this like property quick, so they're just going to put the human psychology is so interesting. They're just going to put the price up because they know people are maybe desperate to close quickly. Are there any other significant changes that people can expect in 2025 that can impact first-time buyers, existing homeowners?
So a change that was made was that there was an increase in stamp duty in November 2024 to second homeowners. The reason they did that is hopefully to make it harder to buy a second home and more expensive, therefore opening up more opportunity for first-time buyers. How much difference that's going to make, we can't really say for sure at the moment, but perhaps a nice change for first-time buyers.
Yeah.
But yeah, in terms of other changes this year, there's not too much to come other than the stamp duty changes. I would expect the market in terms of fixed rate to be relatively stable this year, in my opinion.
Okay.
But yeah, who knows? We'll see.
Yeah. Talking about that, right? Fixed rate, right? I remember when I was getting my property, I got my property in the lower interest rate environment. And the conventional wisdom was, get a 2-year fix, because you can refinance in 2 years and interest rates are low and they're going to stay low. Don't get 5 years. Has that conventional wisdom shifted at all in the last few years? The 2-year versus the 5-year conventional wisdom. What are you seeing that people are doing? Are people still doing the 2 years and then reassessing after 2 years, or are you seeing more people shifting towards the 5 years, stuff like that?
I would say when rates had that sharp increase, in the immediate time after that, I would say more people were leaning towards a 2-year fix. I would say right now that most people see it as the new norm. And I would say whether they'll go for a 2-year fix or a 5-year fix is maybe less impacted by the rates now and more impacted by, do they want to have to worry about a remortgage in 2 years?
Yeah.
Are they staying in the home for 5 years or longer? What is their budget? Do they want to risk a change in interest rates? I would say at the moment, people see it as the new norm and it's less of a factor than it maybe was a year and a half ago.
Okay, cool. Hopefully interest rates just go down. That's what I want. Just hopefully they go down so we can all pay less money, right? We can have a better standard of living. I think that would be nice. So we said that we will talk about mortgage advisors. If people are looking for mortgage advisors, what should they kind of look for and consider?
Yeah, so I would say in 2025, the modern day, people are less likely to just take a recommendation from a colleague or a friend or somebody who they find online. I feel like people really want to work with somebody who they trust, who they like, who they can see a track record of who they've worked with before, how they've helped people in a similar circumstance. So with that, I would say you need to get out there online, really do some research, take your time with it, decide who it is you want to work with. It's a big purchase, it's a huge experience, and you want to have a positive one. Choosing a mortgage advisor who maybe you don't like, you can't relate to, you don't necessarily trust, can impact your experience. So take some time with it. Don't just take the first name who's given to you. Research people online, follow people online. There's so many mortgage advisors online now, including myself. Follow people online and decide, is this the person who you want to work with?
Yeah. And I think that's, like you say, is important. It's not just the first name on the list. It's somebody that because look, you're going to be sharing your personal information, your financial information. They're going to have to work hard for you to get the best interest rate. So like you said, it's got to be somebody that you get along with. Thank you so much, Dan. It's been great speaking to you and catching up with you after a year, and you shared lots of information. So hopefully, not even hopefully, I know this would have been very valuable. We've definitely covered areas that we haven't covered on the podcast before in terms of like mortgages. If people do want to reach out to you, where can they find you?
So my main page is my Instagram page. That is at @DanDoesMortgages_. I'm also on LinkedIn as Dan Knott and also Facebook as Dan Does Mortgages. But the Instagram's got the most information, the most help, client stories of those who have helped recently. And yeah, that's the best place to get in touch.
Amazing. Thanks so much, Dan. Like I said, man, like is really appreciate you, you know, because you're still living up in
the northeast,
up north, right? In northeast, yeah. So look, you've come down for the week, and you know, appreciate you, man. Like just sharing, like all these gems, because I think it really does help people, especially like with. We're probably going to see another shift in the market this year, especially with the stamp duty thing. Probably people are going to be panicking, like, oh, I don't want to pay this, and it just seems to be like a theme every year. There's something that people, but I think it also just tells you that that's just life as well, right? Like if you are in a position where you're ready to buy a property or you're preparing, like you say, speak to a mortgage advisor and don't really be too worried about the market, because the markets, there's always going to be something every year. It seems like this year we now stamp duty changes. Last year, we had other issues potentially, right? Like obviously potentially we had potentially a recession coming, right? 2020 we had COVID, so there's always something happening, right? So I think it's really just about running your own race in these kind of things. So do you have any final words for watchers and listeners? Yeah,
just to touch on that. So there's never going to be a perfect time to buy. Is it a perfect time to buy right now? It's not perfect. However, we simply don't know where the market's going to go in the future. So if you can achieve your goal in the current market, so if you can buy the home that you want to buy on an affordable basis, and it's the right time for you to buy in your life, you're at the end of a rental agreement, you're in a relationship, you want to move out your parents' house, then it's a good time to buy. Speak to an advisor, get stuck in.
Thank you. Thank you so much. I really appreciate you. Thank you so much for tuning into this episode of the podcast, and we'll see you next week's episode.